I'm joined today by Ash McDermott, who is a partner in the London finance practice here at Mayer Brown. He specialises in sovereign debt and emerging markets, so we're going to be talking about that today. Thanks so much, Ash, for joining us. Just wanted to start by talking a little bit, setting the scene. So we've seen, obviously through COVID and recent developments and the war in Ukraine, lots of governments borrowing money. So can you just talk to us about how these recent events have impacted emerging markets?
Sure. Thanks, Amy. I think the first thing to say about emerging markets is that it's obviously a very broad church, lots of different sizes and types of countries involved. But I think broadly speaking, the buzzword that we hear at the moment a lot about emerging markets is resilience. And that is something we'll come back to today. Clearly, there have been immense challenges in the last few years, some of which you mentioned, which have had a huge impact on emerging market economies, as well as things like the strengthening of the dollar and interest rates, inflation, etc. But actually, emerging market economies broadly are weathering the storm very well, except for a few outliers.
Is it more difficult for sovereigns in emerging markets to borrow money?
Typically speaking, no, but of course sovereigns in emerging markets, as in developed markets, are impacted by rising interest rates, as we've seen in the macroeconomic climate recently. And as I said, also things like the strengthening of the dollar. A lot of emerging markets will borrow in hard currency debt, US dollar, euros, and so if their income stream is in local currencies, taxes, etc., then they will be particularly impacted when the dollar strengthens and euro strengthens against local currencies. That being said, there's been a lot of signs for optimism in recent months, especially in relation to areas like Latin America, some of sub-Saharan African countries. There are countries which have been in distress, Zambia, Ghana, Bolivia. But actually, if you can compare previous periods where there were high interest rates in the 80s and 90s, where there were 25 sovereigns in default, including large countries like Brazil and Turkey, the emerging market economies and sovereigns broadly are dealing with the headwinds and the headwinds of the last few years very well.
And what challenges do emerging markets face when they're trying to manage their sovereign debt?
Well, I think, as I say, I've touched on some of the challenges. I think the other large challenge for some sovereigns in emerging markets is perception. And so, you see certain countries like Argentina, who's defaulted in previous years and is in some difficulty now, somewhat cloud the judgments of investors in terms of being willing to invest in sovereign debt broadly. I think a lot of sovereign debt is raised in the bond markets, and the bond markets have been particularly challenging in the last few months and years. The loan market has been a little bit more resilient, and we've seen sovereigns tap the export credit agencies and the development banks, DFIs and MLAs, a lot more recently, which makes sense. Those institutions are counter-cyclical and we're likely to see that continue in the next few years.
And are there any efforts being made to unlock some of the challenges faced?
So from a legal perspective, yes, indeed. During the pandemic, the G20 group of official creditors got together and had various initiatives to try to alleviate some of the stresses that emerging market sovereigns were facing in terms of being able to repay principal and interest on their debt. The first of those was something called the Debt Service Sustainability Initiative. And that was something that effectively in the short term alleviated the interest payments that sovereigns had to make if they decided to adopt that scheme. And actually not many sovereigns did for reasons of perception, again, amongst anything else. We then saw that morph into something called the Common Framework, which again has sort of replaced or got together Paris Club official creditors, London Club creditors, and are looking at ways to alleviate sovereign debt in different ways. Not totally hugely successful as things stand. From a legislative perspective, we've seen the New York State, there are a few bills in front of the New York State recently, which were intended to address the issue that for sovereigns there is no insolvency or bankruptcy regime. So unlike companies where there is well understood and well defined bankruptcy laws in different jurisdictions, for sovereigns nothing like that exists. So we've seen over many years various creditors, often vulture funds, be holdout creditors and prevent a consensual workout in a distress scenario for sovereigns, which has led to things like, if you think of a prominent recent financial institution, not a sovereign financial institution, SVB, Silicon Valley Bank, there was a workout regime agreed in a few days. Zambia, by contrast, has been discussing with its creditors and the IMF for 3 years, and so that's quite a difference. So the New York legislature were thinking of passing legislation which would allow the New York courts to effectively cram down minority creditors where a sovereign has agreed a debt restructuring with official creditors. That can have certain knock-on effects, but the UK government is considering something similar. We're not totally sure whether those will pass, but people have been looking at the issue quite closely.
And if they are passed, do you think they're going to go far enough to have a real impact?
Well, I think a large majority of international sovereign debt is governed by either English law or New York law. Hence why, if there was legislation that allowed the courts in the UK and New York to effectively cram down minority creditors in that way, then that could have a real impact. It would be a meaningful development in sovereign debt restructurings, but there could be unintended consequences. So there is some concern that it would mean creditors saying that we shouldn't use English law or New York law anymore, or indeed pushing the pricing up because there's more of a risk that if you're in that minority and not agreeable to a restructuring, you may be effectively crammed down. So there could be unintended consequences at a time when has been quite challenging for sovereigns to raise debt already. And perhaps there could have been more consultation with the market before these bills were prepared. They have laudable aims, but perhaps these unintended consequences are things that may need to be considered further.
Okay. And how are the macroeconomic conditions impacting emerging markets in particular?
So I think we've touched on many impacts, but I think I'll pivot that question slightly and talk about the opportunities, because we've spoken a lot about challenges. I think there are several opportunities in emerging markets which have actually led to many emerging markets continuing to grow at a similar pace or a greater pace than developed economies. And emerging markets, central banks, many of them, particularly in Latin America, were quick to increase interest rates after the pandemic and hence have been able to keep inflation down. In terms of opportunities, then, I'll give 4 examples of opportunities in emerging markets, particularly in the finance space. One is Latin America, as I've touched on. We're seeing a lot of investment in Latin America equity debt at the moment, probably excluding Argentina, but otherwise there's a lot of activity there. The other is in relation to energy transition, and there's actually 2 in relation to energy transition. One is pure investments in renewables, copper, cobalt mines, things like that. A lot of emerging markets economies are very resource rich, so energy transition, you need resources. And then of course, investments in renewable wind farms, solar, etc. We've seen that to be still very buoyant. And then lastly, some of the dislocation caused by Russian sanctions and the war in Ukraine have resulted in other markets being particularly active. So we've seen a lot of activity in countries like Uzbekistan, Kazakhstan, and also in the Middle East as people try to change their trading arrangements because they're no longer willing or able to deal with Russian counterparties.
And across emerging markets, are you seeing investment sources changing?
That's a very interesting topic. I think particularly in Africa and actually more broadly in emerging markets, in the last 10 to 20 years, China has been a huge player. The One Belt, One Road initiative, or Belt and Road initiative from China, has led to them making huge investments across emerging markets. That has certainly slowed as the impact of the pandemic and other factors going on in China has meant that they've been doing that slightly less. We've also seen US agencies be a lot more active, in particular in sub-Saharan Africa, development banks and institutions, US Exim, the DFC, institutions like this taking a much more active role in recent years in sub-Saharan Africa in particular. We also see, whereas maybe a few years ago you'd see more banks and ECAs and DFIs, we're seeing a lot more funds active in emerging markets now as well, both on the debt side and the equity side. And I think they really buy into the story in emerging markets of growing populations, strong growth, and actually economies which are much better managed now than in previous times of distress.
And how important is ESG in the emerging markets?
ESG, of course, is a very hot topic, as it is in developed markets as well. But I think it's important to recognize that in terms of ESG and energy transition, that emerging market economies may move at different paces and may be at different points along the spectrum in terms of ESG. And I say that because, for example, Sub-Saharan Africa contributes such a small amount of greenhouse gases to worldwide emissions, and have other things that they're dealing with that we've discussed, other issues. So ESG, in that sense, if you were to offer them a sustainability-linked loan, where they may shave a small amount off their interest rate, but have to go through various hurdles, it may not seem like the obvious thing to do. But ESG is super important in terms of unlocking capital. Many funds and other institutional investors worldwide require certain ESG standards for investments. And of course, as we've touched on, in terms of critical minerals that are necessary for ESG globally, we're seeing a lot of emerging markets really come to the fore in that respect.
Ash, thank you so much. I've got one final question for you. For anyone who's watching today, what would be your key takeaway points?
My takeaway points for emerging markets generally, and including sovereign debt, would be avoid the risk perceptions, look into your counterparties and jurisdictions specifically. Emerging markets jurisdictions are very diverse and there are different issues and opportunities in each. And remember the buzzword resilience.